What is going on, you guys, and welcome back to the channel. Today, I'm very excited to review a brand new suite of dividend ETFs here in Canada. It's the Hamilton Champions ETF suite. Now, thank you to Hamilton ETFs for sponsoring today's video. While this is a sponsored video, my goal is to do a full highlight and showcase of this ETF suite, talk about what I think is exciting about it, and of course, some things to be aware about. Now, to kick things off, what I think is so unique and special about this ETF suite is it might be a little bit different than what you're used to from Hamilton ETFs. We've talked about Hamilton a ton in the past, known and recognized for many of their popular high yield solutions, often using covered calls in their strategy. Well, here today we have a flat out, I'm gonna call generic, I don't know if that's the right term to use, but a generic low cost dividend investing option. We'll dive into a fund focusing in on the Canadian dividend space, a complementary possibly fund on the US dividend space, giving you exposure to US dividend stocks, and no covered calls, no leverage, just your low cost dividend ETFs. And what's exciting to me is, of course, that's expanding the suite of options from Hamilton, previously known as maybe only a high yield solutions company. Of course, however, in Hamilton fashion, as part of this new suite of releases, you do also have two versions of those same underlying funds with the leverage applied. We'll talk about that in a second. But let's start off with the two new underlying products in this suite. We have CMVP. MVP, kind of a fun play on, I guess, winning champions, MVP. We got CMVP, which is the Hamilton Champions Canadian Dividend Index ETF. We also have SMVP, which is the Hamilton Champions US Dividend Index ETF. Keep in mind both Canadian products. To dive into CMVP first, this is an equal weight portfolio of blue chip Canadian companies with a long history of rising dividends. We have a 0% management fee through January 31st, 2026. We'll talk about this in a moment. A good fit for investors who want low cost exposure to Canadian dividend growing companies, tax efficiency from Canadian eligible dividends, and lower volatility with the potential for long-term outperformance. Now, the index that it is tracking, as we can see here, we're not just tracking the TSX 60, the broader Canadian market. It's the Selective Canadian Dividend Elite Champions Index. And this is an index that aims to provide exposure to equities, particularly with a long history of stable and increasing dividend payments. Now, keep in mind what you're looking at on the screen. This is the performance of the index, not the fund itself. These are new funds that just launched, but the index that they are tracking, well, it boasts a higher yield, a higher CAGR, lower drawdowns and time to recovery, very important to consider. And of course, the Selective Index does boast the higher yield when compared to the TSX at 3.60 versus the 3.0. Now, to break down some of the holdings or the breakdown of this particular fund, well, it's very true to the Canadian market. We see the biggest weighting coming in at financials, about 37% of the fund. Energy's coming in second at 15%. Materials, industrials, very much what you'd expect out of a Canadian fund, with the top holdings being companies such as BMO, CIBC, the Bank of Nova Scotia, Loblaws, Sun Life, Couche-Tard, Manulife, Magna, and Enbridge. Now let's jump over to the US counterpart, if you will. You're gonna see a very similar story, but this is ticker SMVP, the US Dividend Index ETF. Again, an equal weight portfolio of blue chip US companies here with 25 years of raising dividends. The same 0% management fee through January 31st, 2026, lower volatility versus the S&P 500 with similar long-term performance, and a good fit for investors who want a diversified portfolio of US dividend growers that have delivered strong performance and low volatility. This is the low-cost US dividend growth ETF. This fund is 100% hedged to the dollar, Canadian dollar, and of course you got the monthly distributions for that frequent income. Now, as for the index comparison, similar to what we looked at before, you're gonna have similar characteristics. You have a slightly higher yield at 2.3% versus 1. We have the lower peak to trough, the faster recovery, lower valuations in general. And I do point out here, a fraction lower in return. I mean, this is a fraction, so that does come, of course, with the increased yield. There's the trade-off you're making. In terms of the holdings, you'll see top heaviness in completely different sectors than the Canadian option that we previously looked at, with industrials being the largest at 24%, consumer staples at 23%, healthcare, 14. Notice all dividend heavy sectors. Notice this is quite different than your typical S&P 500 exposure. If we looked at the S&P 500, we know technology, information technology is right up there with all of the big FANG stocks or the Mag 7 stocks. Well, this is one that's more of a focus on dividend stocks. We could even look at lower beta stocks and lower beta portfolio in general. In fact, to take a look at the exact holdings, we see here companies like Walmart, Emerson Electric Co., WW Grainer, Fastenal Co., Cisco Corp., ADP, Automatic Data Processing Inc., Stryker, Illinois Tool Work Inc., Procter & Gamble, Chubb. These are, of course, just the top 10 that we're highlighting today. Now, these two funds, in summary, are two options to get you exposure either to Canadian side or the US side of companies in North America that are steadily paying dividends and increasing their dividends. That is the focus. We could look at it like a dividend aristocrat ETF. We talked about fees earlier, and I mentioned that I'd bring it back up. Well, we did see the 0% management fee listed on their website, which I will be including down below if you guys like to check. But if you do take a look at the fine print here, this fee is rebated through January 31st, 2026. So essentially a year or so out as of the time of filming this video, depending when you're watching. And going forward, the management fee will be 0.19%. So very truly a low cost, I want to say, generic dividend ETF investing option. If you are familiar with some of the other options available, that's right in the range, not only competitive, but actually right there as some of the lowest cost options that you will find out in the market for a dividend specific ETF. Now, to re-emphasize, we did cover this at the top, but very important that we're aware, these two funds that we just covered, they do not incorporate a covered call strategy. They do not incorporate leverage. These are more or less your generic low-cost dividend ETF options. Again, in my opinion, very exciting to see from over on the Hamilton team. Now, however, as I know there are many investors out there that do like and opt for the enhanced versions, you'll be very excited to hear of the two additional funds being released in this suite. In true Hamilton fashion, we have the enhanced versions. And what we're looking at here in terms of tickers is CWIN, so CWIN. This is the Hamilton Champions Enhanced Canadian Dividend ETF. And of course, on the US side, we have SWIN, which is the Hamilton Champions Enhanced US Dividend ETF. And as you'll see, these literally own the exact underlying funds that we just covered, still targeting the most established companies out there across North America, obviously via their respective funds, US and then Canada, still targeting companies with a 10% annual dividend growth, 25-year track record on the US side, but also implements and applies the modest 25% leverage that you're used to. I emphasize there the keyword modest. You guys already understand that when you do apply leverage to any investment, well, of course, that enhances the potential for future growth, not just on the growth, but also on the yield. That does, of course, come with increased volatility on the downside. Now, important to note, as I throw back up the holdings just as a quick review, keep in mind, they are using this leverage on a blue chip stock portfolio of stocks that already tend to have a lower beta. These stocks in general, residing in sectors like the consumer staples sector, the healthcare sector, and financial sector, they tend to be less volatile stocks to begin with lower betas and an overall lower portfolio beta. So an argument that would be made is that the modest amount of leverage applied to some already more, I don't want to use the word conservative stocks, but let's call them lower beta, less volatile stocks, somewhat evens things out. And if you are a believer long-term in the growth of these indexes and you're an investor that over time believes they will continue to grow, well, looking here, the index again being tracked, it has provided outsized performance when compared against the non-levered version. Of course, you need to do your own research and due diligence to see if this is a product that makes sense for you and you're comfortable in the market. Now, in terms of fees, the fees here do come in higher at the typical management fee of 0.65%. Important to note, of course, there's no double dipping or fees on the underlying, even after the rebate period is done. It's 65 basis points for a management fee you're looking at. I'll note here as well, the fund is rated medium to high when you factor in that leverage. Alternatively, on the Canadian side, this one comes in at just the medium. Now, of course, as always, I will include down below this video links to these exact products that we covered today. You can go do your own due diligence, go do your own research. What I personally like about this new suite is it has options. It has options for more of the generic investor who prefers not to use or apply any amount of leverage. You also have the funds building off that, which do have those options. At the end of the day, I'm personally very excited to see Hamilton, one of our amazing channel partners, expanding beyond just the covered calls. To me, it's exciting to see what the future will come when there's all of these different options out there for different types of investors. Of course, on their website, you can explore and find all of the amazing other options that they have that do cater towards the high yield audience. I'll wrap it up there, and once again, thank Hamilton ETFs for sponsoring this video. Let me know your thoughts down in the comment section below. What do you guys think about this new ETF suite?